You can change the quality, the classification of a property with renovation, but it's much harder to change the classification of a neighborhood.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always, we got Matt Jones. Matt, how are you doing today?
I'm doing fantastic. How are you doing, Todd?
I am doing excellent, man. Doing excellent. I closed on two assets, actually three assets over the last week and a half, 2 weeks. So I'm excited about that. I got rid of an asset that's been kind of a problem. I purchased it. I had one partner on it. I bought that partner out, and it's just been a problem property. Made some money on the sale, so I'm happy to get rid of that. Went full cycle on two syndications, so that was really great. Did excellent on them in the end. They both got their own stories, so we'll probably do story time. Actually, I'll probably tell the story of all three of those assets and the whole process here, maybe in the next couple weeks. But they've all got kind of their fun stories, went full cycle. So that's always good. You always get the investor call and somebody says, have you gone full cycle? I've gone full cycle on a lot of properties, but not a lot of syndications. And so these are actually the first two full-blown syndications that I've gone full cycle on, where I did large syndications. I've done some smaller stuff that I've gone full cycle on, but nothing like this. So it's kind of fun and exciting to go full cycle, see the results, positive results on it. And I'm hoping this week I'll have at least one, if not two properties under contract. So we'll see.
Awesome. Yeah, and as you know, we were just under and a best and final for a 254 unit place down in Atlanta, but we had to step away from that because it wasn't quite what we wanted. But that was the first property that I've been in an LOI on for a 100 unit plus property. So, I mean, it's getting more and more real for me. If I have done it once, I can do it more and more. So things finally have some decent deal flow from brokers. And so it's a numbers game for me right now.
Yeah, the deal flow seems like it's picking up throughout. I suppose this probably depends on where you're at, but where the markets I'm in, the deal flow has been picking up quite a bit. And, it's still a hot market. So you got to be choosy. You can't just buy anything that's coming. It's going to be difficult still to buy properties, but you got to look at them. If you're going to buy, you've got to be looking. If you're going to buy, you got to be writing LOIs. You've got to be taking action. If you're not taking action, you're not going to get a deal. You can't, I think it's funny when you hear people, I can't get a deal. Well, how many LOIs have you written? Well, I haven't written any. How many deals have you looked at? Well, I've only looked at a few. Well, okay. Well, there's your problem.
Yep, exactly. Got to go through the numbers.
Yep. So Matt, what are we going to be talking about today?
Well, we're going to continue the multifamily series here. And today we're going to be talking about the different classifications of buildings as well as neighborhoods. So A versus B versus C and D. And so I'll just jump right into there. It depends on what your investment strategy is as to what quality of building that you want to buy and what shape. And just real quick, the difference between the different classes. A is your brand new properties. It's like, a maximum of 10 years old. Things are in great shape. Things aren't breaking down. And you have high-end tenants that are paying top rents. And then B is anywhere from 10 to 25, maybe 30 years old properties that, it's not brand new, but it's still in decent shape, maybe needs an upgrade and such. And class C is going to be older than that, older than 30 years, in poor shape. You got some middle class blue collar tenants and anything that's also 30 or more years, but it's in really bad shape. We consider that to be more of a D level property.
Yep. Yeah. And of course that can vary, right? So you could have an A-class property, quite frankly, that's 100 years old. It's not necessarily an A-class building unless it's really been completely overhauled, but you can get it to where the finishes are in A-class condition. You redo all the mechanical systems, all the windows, the roof envelope, the whole envelope of the building. And you know, the interiors, and that could still be an kind of an A class. So it you mentioned the age, and you're 100% right, but it can also depend on the level and the time of the last remodels, right? So I can take a C class property and turn it into maybe not an technically an A, but I can turn it into to being more like that B plus A minus type property, and maybe it's even 50 years old, 40 years old.
Mhm. Yep. And for our listeners, if you're going to be doing anything with commercial properties, you really need to get to know these different classification levels, because when you're going to be talking with brokers, if you don't know these, they're going to know that you don't know what you're talking about.
Yeah. And so we also sometimes call those core properties would be an A class. Core is a property that needs nothing. It's turnkey. It's ready to go. It was built 3 years ago. Core plus is going to be that 10 to maybe 15, maybe 20-year-old building that needs a little bit of work, needs some new flooring. Maybe it needs some countertops. Maybe it needs some paint, just some minor stuff. Then you've got your value add property. Those are your B and your typical BC class properties where you're going to do, flooring, cabinets, countertops, light fixtures, plumbing fixtures, paint, that kind of stuff. You're going to maybe stick like $8,000 into it per unit. And then you've got your reposition or your full renovation. And those are the ones where we really are sticking major bucks into. We're sticking, 15, 20, 30,000 per unit into it. And we're really doing a major reposition, right? We're taking it from a C to a C minus, maybe to a B plus or something like that. So you might hear it called different things. A, B, C, or a core plus, value add, reposition. So,
and like you just mentioned, you can also have pluses or minuses added to the letters, so you have different gradients within each letter.
Yep. Just think about in school, you weren't quite smart enough to get a B, you got a B minus. So,
you can also have neighborhoods that have the same sort of level classifications as well. And that's based on what the predominating, type of properties that are in that area. So if you've got a lot of A properties in an area, in a neighborhood, then that's going to be an A neighborhood.
Yeah. I mean, look, you got all the shops and the cool, trendy restaurants. You got a lot of retail in there. It's that hip neighborhood everybody wants to be in, and so you could have a C class property in an A neighborhood. In fact, we just purchased a probably C minus, maybe even D plus property in an A neighborhood. And now, can we take and bring it to an A class property? No, not really. It's kind of got some things in there that doesn't make it A class, right? It's got 8-foot ceilings. A class would have 9-foot ceilings. It doesn't have kind of the exact layout you would be looking for in an A class. So that's going to make it not quite A class. It doesn't have a few of the modern amenities, no underground parking. It's got a pool, it's got some other cool amenities, but it's missing some of the pizzazz that an A class building has. So what can we do since it's an A class area? Well, we can give it A class type finishes. We can add A class type amenities, and we'll settle with calling it a B plus A minus type building.
Mm-hmm. Yep, exactly. You can change the quality, the classification of a property with renovation, but it's much harder to change the classification of a neighborhood. Like you'd have to buy the whole neighborhood and renovate the whole thing to do that. But what you can control is the property itself.
Hey, real quick, I just want to let you know about the multifamily challenge that we got going on. It's a 5-day multifamily challenge on how to get an offer in quickly, right? So we're going to teach you in 5 days, 5 1-hour sessions. We're going to go through the steps and the process to get there. So go to mfichallenge.com, mfichallenge.com. You can sign up. It's free. If you want the VIP, there's a bunch of things that we'll give away too. You do have to pay for that, but hey, it's going to be well worth it. Again, you can get in for free. We're going to teach you how to get that offer across the table, get the LOI in, all the steps. So Ellis Hammond and Ellis was episode 316. Check out his episode. And we're going to be doing this next week. So sign up now at mfichallenge.com, and get in there. We're doing it next week, and it's going to be awesome. So hope to see you there. So what I want to get into, Matt, what I want to dig into, and so if you've listened to this, you're like, okay, I get it, right? What I want to dig into is, why is this stuff actually important, and why you as a buyer. So we've talked some of why it's important, but why is you as a buyer really might not want to be focusing on certain types of properties, or you should think again when you're thinking about, oh, that C-class property's got great cash flow, or that I really like that A-class, property, that core property. So what I hear a lot of people, I'm talking to a lot of coaching clients, and they're like, well, I can't be buying, and this goes to, by the way, markets too. And they're like, I can't be buying a 5 cap. Doesn't make sense. And I go, well, wait a second now. Why doesn't a 5 cap make sense? Well, I can't get my cash flow. Okay. You can't get amazing cash flow on that. I get it. You're right. You just can't. But what you've got is a ton of value.
Yeah. And the higher the quality of a property, the lower the cap rate that there's going to be, because there's lower risk at the same time.
Right. And so 100% right there. Things look good on paper sometimes, right? We can underwrite, we can make it look really good on paper, but when it actually comes to performing, can you perform on that property? Can you actually get the collections? I think that's the biggest thing when I look at C-class properties. In my experience with C-class properties, I just sold 2 C-class properties. And I look at, we were able to get our rents, but we were able to get our rent amounts, but we were not able to really get the collections that we wanted to. And that can really drastically change your NOI. So on paper, it looks really good, right? On paper, it's like, wow, we're going to be able to blow this thing out of the water. But when push comes to shove, if you can't get your rents, well, then the cash flow doesn't look any better than that A-class property, or maybe it even looks worse, right? So we've got to think about reality. One of the, here's the other thing, and this is big. And so if I'm buying a property that sells at, it's an A-class, it sells at a 5 cap, right? And so let's say I buy this thing 5 cap, I run it, and I do some sort of value add, and I can raise rents, right? And I can raise rents. Let's just say I can raise rents and change my NOI, which is my net operating income, by $10,000. Okay. So if I can change my NOI by only $10,000, okay, that's not very much. Okay, that's a very 100 unit building. That's just a small little rent bump, right? But if I can change that by 10 grand, I just created $200,000 worth of value. Okay, now let's say I can change it by, let's say I got a 100 unit building, okay, and I can raise rents by just $100 a month. That's $10,000 a month, which is what? $120,000 a year. Now, at a 5 cap, I would take $120,000 because that's how much I raised my income by. And I divide it by 5%, and I come up with $2.4 million worth of value. So I just created $2.4 million on that 5 cap because it's an A-class property. Now let's take that C-class property. I'm going to use probably a more drastic number than the change would be, but let's just take that C-class property and say it's an 8 cap. Okay. And I do the same thing. It's 100 units. Okay. And same thing. I've got $100 rent bump a month. Okay. So we get the exact same amount, right? $120,000 per year. Okay. If I just take that and divide it by 8%, that's $1.5 million worth of value. That's $900,000 less that I made by doing the exact same amount of work, by raising rents by $100. Now, let me qualify this even more. If I've got an A-class building, my rents are, let's call it $2,000 per month. Okay. If I take and raise my rents from $2,000 a month to $2,100 per month, what did I raise my rents by? How big of a percentage did I raise my rents by? 5%. Yeah. Sorry, 5%, right? Now, if I've got that C-class property and I've raised my rents from $1,000 to $1,100, what did I raise my rents by? How much?
10%.
10%. I raised it by double the amount. How do I expect my C-class tenants to actually pay 10% more when my A-class tenants are only going to pay 5% more? Right? It's probably not going to happen. In fact, my C-class class property and tenants, they're only going to probably pay, maybe 3%, maybe 2% more because they can't afford that bigger jump. So the gap has been getting bigger between A and C, not smaller. So, but even if you can raise it $50 a month at 5%, now you're only raising your income by 60,000, and we divide that by 8%. Now we're at 750 versus 2.4 million. And that's $1.65 million worth of value we have for our A-class. Quite the difference. So look, your cash flow might not be as good. Okay. Might not be as good. But the power of raising our income compared to our cap rate is a noticeable difference. So just remember that as you're looking at it. When I look at what the history has told us, now some people will argue with me on this, and that's okay. I'm okay if you don't agree. But if you look at the history of the last several recessions, the areas that were well located, the areas that were that A and B class areas withstood the recession, right? When I look locally at my market, I look at the specific areas and cities that are more A class, B plus. They had a lot less pain during the last recession. The house values went down way less. I look at where I live currently. We lost very little value in housing in the neighborhood I live in now. Now, I didn't live there during the last recession, but I paid attention to the market and a lot of markets around. And where I live just didn't lose that much value. And so, lesson to be learned. And when I look at what lost the most amount of value, it was your C class and D class neighborhoods. You were picking stuff up for $10,000, $20,000, $30,000 for a house. All right. And they used to sell for $200,000. So lost massive value. Where your A class neighborhood was going at, $500,000, $600,000 or maybe more, but it went from 500 down to 425, 450, lost value, but not that much.
Yeah, the blue collar workers who are living in the C and D quality places, they're just impacted more during a recession, and they don't have the wiggle room like the wealthier people do.
Yeah. Yeah. So something really to think about as we're choosing classes of properties is how are things being affected? Now, I'm not trying to slam C class properties because I've purchased a lot of B and C class properties and I've done really well on them. You just have to be aware of the difference is in what you're actually getting out of those properties, and decide what's right for you. The management is definitely more challenging, but if you execute properly on a C and a B class, you definitely have opportunity to do really well. Here's where the difference, I think, in A versus B versus C and versus maybe D. You have a lot more opportunity in B and especially C class to find a true value add, to find something that's distressed, to find something that really, really, truly needs some special attention, right? And so you have the best opportunity to find a discounted property, where an A class, like I said, even during the recession, didn't go down that much. You just don't have as much opportunity to find a distressed asset in that market.
And like you were saying, I mean, you can make money in any of the classes. It just all depends on what your investment strategy is as to which class you want to do. And my wife told me that I'm not allowed to become a slumlord, otherwise she'll murder me. So like D class properties are not an option for me right now.
That's awfully violent, man. Well, could you just leave you instead of murder you? I mean, man. But yeah, I agree. You don't want to become a slumlord, but that's how you lose money. That's the C class property is in even some B class property. And that's how you lose money is you become a slumlord. Now, I think a lot of people become slumlords. There's several reasons. One is because they just don't care, and maybe they're even bad human beings. But another is because they're not financed properly. They don't have the equity. They didn't raise enough money. They didn't think about the issues that could come up. And then when a couple things happen poorly, they can't do repairs. They can't take care of their tenants because they don't have money to. It's because they weren't capitalized very well. That happens a lot in these properties. And it's because they had rose-colored glasses in the first place. They thought things were going to look really good. They were going to be able to boost the rents right away, and all of a sudden they couldn't.
I'm in the same boat as you of the value add, because if you're creating better living conditions for people, they're going to be thankful. They're going to want that, and they're going to be willing to pay a little bit more. And if you can decrease expenses at the same time, then you're creating a lot of value for yourself as well in the property.
Yeah, for sure. Well, cool, Matt. That's all I got on the A, B, C, and D class properties. You got to decide what's right for you. There's different management strategies for all of them. There's different value add strategies for all of them. And you got to decide what's right for you. And if you're working with investors, what's right for investors. But just a little food for thought, I think, for people. You're really looking at these. You saw the math. You saw how quickly we can add value doing different things to these properties and what it looks like. So run your numbers.
Sounds good.
Cool, man. Well, you have a fantastic rest of the day. Make every day Saturday.
You too.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.